afternoon. Thank you for joining us today for Surge Energy's Q1 recap. Surge trades under the ticker symbol SGY on the TSX and ZTPAF on the OTC. With us today from the company are President and CEO Paul Colborne and Senior VP of Exploration Derek Christie. Same person, different title. After the presentation, there will be an opportunity for Q&A. Please enter your questions in the Q&A box. As always, the presentation may contain forward-looking statements. Good afternoon, gentlemen, and thank you for taking the time to be with us today. I will now turn it over to you to hit the highlights of the quarter.
Thank you very much for the invite. We're going to be quick. It was a really solid quarter for Surge. Nothing glitzy, bang on estimates for production, cash flow, coming in maybe a slight bit above cash flow per share, but bang on with our 12 analysts. So in 2022, we were the top performer of any oil DivCo in Canada, TSR 112%. In 2023, we were a good performer. 2022 oil average 94 WTI. We have the most torque, or some of the most torque, in our cash flow to higher oil prices of any company. In 2023, we had a solid year, a really good year. We were not the top performer, but oil average 77, and we just continued to chug along and deliver on all of our key debt repayment targets. We increased the dividend 14% during the year and hit our debt targets as the year unfolded. Now, in 2024, where almost every brokerage houses, we are covered by 12 of the top firms in Canada, and we're almost everyone's top pick or a top pick of their firm. Why? Why is that? So the real thing I could point to is on this second page here. I'd love to say it's myself or Derek, but it's our asset quality. So you're going to see that we have two of the top plays in all of North America for well payouts. And now exiting this year, that'll be close to over 80% of our company, closing in on 85% because of our asset quality. And what that means is high quality, low risk, large oil in place, conventional reservoirs in a year where there's year-round access, multi-zone targets, lots of takeaway capacity, and low-cost drilling, conventional, plus water floods. Well, what's that deliver? Free cash flow and net asset value. This slide here shows the macro side of things. We think oil is set to absolutely rip due to chronic underinvestment for close to 9 years now. And you can see where the rest of us are, the US, Canada, Europe, are 20 barrels a day per person per year. India, China, Asia, and Africa, 6 billion people out of 8 are averaging around less than 3 barrels a day per year. So as they even get to 5, 6, it's we think crude just keeps ripping up to the right. This is the slide I wanted to mention to you. We have the most torque to oil of any company in Canada. And this is a National Bank slide on the right there. Yangera is a gas company at the top, so I'm not sure why they're on this slide, but it just says for every dollar increase in WTI oil prices is almost 9 million, 8.9 million of annual cash flow to Surge. No other company has that much torque to crude oil prices than Surge. And you can see our stock price, there's a high correlation. When crude rips, Surge rips. We think with 2 wars going on, one in the Middle East, and the physical tightness in the market, that it sets up well for Surge.
Quick question there, Paul. You've also benefited from the line fill for TMX with diffs narrowing for both WCS and MSW. So what's your view on longer-term diffs?
Our view on longer-term diffs is that the big guys will ultimately fill up the TMX. Do I think the blowouts to 25, 30 bucks are going to happen? Probably it'll smooth those out. But the long-term average is around 16. So we just did a hedge for all of next year at 13.85 US for WCS diffs. So we're a believer anytime in crude, the spot is around 12 bucks. So it's come off $19 WTI diffs in Q1, and it's around 12 now. The strip is around, as I said, 13.80. We did a deal. So we're price takers. We'll take that diff price anytime we can get it in the 13s, 12s. And if it goes lower, we'll never hedge more than 50%. Then our other stuff is getting that lower differential. But Long term, we think the big guys, it's inexhaustible what they have up at Fort McMurray. They'll just keep putting it down the line and bring on another train. So we like hedging in that $13, $14 range if we can.
And mainly do colors kind of thing?
This one was a straight physical hedge. We have
Okay.
done colors in the past. So what we're trying to do is reduce the variability. And it's the strip is right around 14, just under. So we love that because our budget's at 16.
Okay, perfect. Thank you.
Yeah, so this slide is simply the 9-point partner showing that Surge, another thing it delivers is free cash flow yield, having those quality assets. So we have one of the best free cash flow yields in all of Canada for any oil company in our DivCo peer group. These are our annual numbers this year. So at 75 oil, we're going to be just under 300 million of cash flow. We have a $190 million capital budget, and our dividend is $48 million. So we have a dramatic amount of free cash flow, about 105 million of free cash flow. We're getting close to hitting our next debt target. When that happens, we will have another 57 million of cash flow that's free to allocate out. And that could be a small bump to the base dividend, start our share buyback program, and continue to pay debt down. I kind of went through that, but this is our current, we're very close now to hitting our phase 2 net debt target. But really exciting is then would be on to our terminal debt target of phase 3. So we're quite close to the 250 million second debt target. When that happens, we probably look to a small bump to the base dividend and definitely start our share buyback program. We've always had one, and we decided that debt was a priority the last few years. So it's exciting to start meeting and beating these debt targets. I brag a lot about our asset quality. I did at the start of the program or start of the presentation. So all I'm saying is this chart is great, and Derek will show you empirically why it's great. But high quality, low risk, low cost reservoirs from 0.1 mil at RC and Bedrock on the right wildly and dramatically outperform operationally and financially deep, expensive, tight rock with huge costs, huge fracs, huge declines that don't waterflood. That's it. There is no more secret sauce. That is the reservoirs that Surge is in worked for the super majors in the 50s when they came to Canada, the Shaunman, the Sparky, Southeast Saskatchewan. They were in the 50s, oil was $3. Imagine how good they work for Surge now at $80. Derek's going to show you empirically now what that means to our shareholders. Derek?
Great, thanks, Paul. So on this slide, we have a summary of all of the oil in place and locations that we have as a company. So we have 3.1 billion barrels of oil in place that we own on our land. The cum-to-date recovery factor, how much oil has come out of the ground, is less than 8% of that 3.1 billion, 7.7%. And then in our independent NAV that is done at year end with our Sproul, that's booked to about an 11% recovery factor. When we think of conventional reservoirs like this, we are going to be seeing recovery factors on a primary basis of about 20%. And then when we factor in water flood, we're going to see recoveries act about 30%. So when you think of what we have, 3 billion barrels of oil in place, low cum-to-date recovery factor of 8%, booked recovery factor of less than 11%, and then a runway all the way up to 30%. Then when you think of reservoirs like this, just a 1% change in these large oil in place pools of 3 billion, that's 30 million barrels of recoverable oil. So really substantial just for a 1% change.
Oh, just one question there. Of the 1,000 locations, I think you use a cutoff for tier 1 of less of a year and a half payout or better. Is that correct?
That's correct. So of the 1,050 drilling locations, 2/3 of those drilling locations are tier 1 or tier 2 drilling locations. How we define that is tier 1 is anything that pays out in less than a year at $80 oil, and tier 2 is anything that pays out in 1.5 years or less at $80 oil. Good question. And then also just talking about the drilling location. So we have 1,050 total company, but more than 75% of those are in our 2 core areas, being the Sparky and Southeast Saskatchewan. So very focused. I would mention our NAV as well, mentioning that Sproul year-end report. So on a proved basis, PDP, it's $5.66 per share. And then that moves up to, on a 2P basis, to $17.63 a share. So lots of runway on the NAV as well. Just going to talk a little bit about the Sparky and Southeast Saskatchewan, really two of the top three oil plays in Canada. 80% of our production comes from those two areas. 95% of our capital is being spent in those two areas. In Q1, we drilled 10 wells in Southeast Saskatchewan, 11.4 in Southeast Saskatchewan. So going on for the rest of the year, we see another 27 wells being drilled in the Sparky, and then another 23, 19.7 gross wells drilled in Southeast Saskatchewan. So a lot of wells left to drill for the remainder of the year. So again, really focused in these two top core plays, 95% of our capital being spent there. So an obvious question is why? Why are we spending all of our money there? Well, this is some independent research that was done by Peters & Co. And what it did is it ranked all of the oil plays in Canada, actually North America, just on a half cycle, 1 times payout period. The top 4 plays that came, that rose to the top were the Frobisher in Southeast Saskatchewan, the Clearwater, the Charlie Lake, and then the Mannville Stack conventional oil plays. So we have dominant positions in 2 of those top 4 plays, where 80% of our drilling inventory lies within those top plays. A little bit more detail around the Sparky, part of an 11 billion barrel oil trend. We have a lot of geological data here. So there's been more than 20,000 vertical wells that have been drilled into this map sheet. So what that gives us is well logs across here. So we have a lot of geological data. We integrate that with all of our 3D and 2D seismic, and then utilize offset production engineering to really have an integrated reservoir model. And what that's done for us is helped to de-risk our past drilling. So we've drilled more than 225 successful single leg wells out in this area and 18 multi-leg wells. But more importantly, utilizing that model, we have more than 475 additional locations that we drill for future growth in this area. You know, this really shows the growth that we have had. So we've really grown since 2010, 2011, less than 2,000 barrels a day, to where we sit today, over 12,000 BOEs a day. As I mentioned, we have that 470 drilling locations, and then that strong production base. Talking a little bit about the multilaterals, we've been really focused on advancing that as part of our portfolio. We have drilled 18 wells to date across our asset base, really focused recently on our successes in Betty Lake and Hope Valley, where we drilled 2 wells in Q1. The current rates that we see there, so in Betty Lake, we have a IP90 of over 300 barrel BOEs a day on that recent well. And then in Hope Valley, we see about 250 barrels a day on an IP60 basis. So really excited about the success we've had drilling those multilaterals. We have a fairly conservative number of 85 drilling locations that we say we have for multilats. 35 of those are in Hope Valley. We see that moving up just with the success we've been having.
Just we could just stay on that slide for one sec. So you did run seismic, and you were able to stay in the zone for, I know, a lot more effectively than on the historical wells you drilled.
Yeah, go ahead. Yep.
No, I was just going to say, do you think 12 legs is the ideal number for completions on these wells now?
Sure.
That you've enough?
Yeah, so I'll answer that in a couple different ways. But so backing up a little bit, this is our 3rd well in Hope Valley. We drilled 2 wells previously, then we shot a large 45 square kilometer 3D seismic program. What that really helped us do was to dial in our geological placement of this well. We were able to stay in a really top quality reservoir for 90% of the time. Drilled more than 17,000 meters of open hole, so 17 kilometers of open hole through those 12 legs. We really feel that in this area, the 12 legs is fairly optimized, so that's what you'll see us going forward drilling. We do like that number. We have talked about potentially decreasing that number just to help with some of the cost efficiencies, but at this point, we like the 12 legs. Okay,
great. Thank you.
Moving on to just the single leg frac wells. So this has kind of been our bread and butter. It's something that we still do a lot of. So we really like the single leg frac wells. What that does for us, it enables us to really access all of the Sparky sands, and then it also gives us water flood to be able to have some additional recoveries here. I just point your attention to some of the numbers you see in the call-up boxes. Again, these are great wells. So we're seeing IP90s ranging from 130 to 190 just on this map sheet and some of the recent locations that we've drilled. And then to put that in perspective, just with our type curve, we have just 108 BOEs a day of what we use for our type curve on an IP90. And that generates a payout of less than a year or right around a year. So these wells that we're drilling recently have slightly better than that, so less than a 1 year payout. And again, nice depth of inventory on this. So just in this Provost area, we have greater than 130 drilling locations to follow up. This has been a real bread and butter for us. Jumping into Southeast Saskatchewan, this is an area that really complements the Sparky very well. We have, compared to the Sparky, where we're either drilling multilaterals or drilling single leg frac wells, here these are really open hole wells. The rock is so good, we do not need to fracture stimulate in any way. We are drilling multi-leg wells, but compared to the Sparky where we drill in a horizontal fashion, here we're drilling multi-leg stacked horizontals. Low cost of drilling here, we're about 1.5 million drill complete equipment tie-in, very quick turnaround just because we do not need to frac them. Lots of organic growth opportunities. So it's just a great complement to our Sparky. And the results here have been phenomenal. This is probably my favorite slide in the whole deck because it really just helps to show the results that we've been having. What it is it shows all of the wells that have been drilled over the last 2 years in the Frobisher, just dump out a GeoScout. And then the average IP90 is what's on the x-axis there. So you can see Surge has drilled 56 wells with an average IP90. So 3 months of production of close to 180 barrels a day. So really industry leading down here with a really large data set. Then you can see that we do have many follow-up locations. So we have 290 total locations. About 220 of those are Frobisher. Put that in perspective, we're going to be drilling, probably about 30 wells down here this year. That gives us about 6 years of top quality Frobisher drilling going forward. Just a little more detail around that stacked multilateral that I was talking about. So you can see this is a type log that, so in a vertical sense, we target different members within the Frobisher, within the Hallbright and the Untune, and then stack those laterals. So you can see that that's a way we've been really able to get some really phenomenal results out here. And just what I like about the map we're showing here is it's across our entire asset base. You can see just the outperformance that we're getting. Looking at the well to the farthest to the northwest, that's an IP90 of 450 barrels a day. Moving up to the north, IP90, 225 barrels a day. And then all the way down to the south in the middle of the pool there, 350 for an IP90. So really across our asset base, we have multiple wells that are really outperforming our type curve. You look at the type curve, that's 180 BOEs a day, which is our average that we've had down here. And you can see the phenomenal payouts of 0.4 of a year payout. So really just phenomenal economics, and really excited about the depth of inventory we have down here and the track record and success we've been having.
Is that a lot geological success, result of geology or completion technique, or both?
So it's really got nothing to do with the completion technique. It's because we do not have to frack these wells. We don't really do anything that special when it comes to the drilling fluids either. So it's more drilling the best rock in the best pools that's really given us those results. So large pools like Steelman really have the opportunity to outperform. An average pool in Southeast Saskatchewan, often there are 1 to 2 sections. This is substantially bigger than that, over 20 sections. So it's a large oil in place pool.
Is there land surrounding what you have right now that could be of interest, or is that all pretty much?
So actually, I'll talk to the map a little bit in that way. So anything that we've bought through acquisition is in the green land. So that would be Astra and FireSky. Anything that we've done subsequent to that period is lands in yellow. So you can see that there's been a lot of organic growth down here through some real key land sales, very competitive land sales that we were successful at, and then really some key strategic farm-ins that we've done. We've been able to add that. On this particular map sheet, there's probably not that much more land that's available, but we are continuing to come up with similar prospects to this and always growing our inventory through crown sales and strategic acquisitions. Anytime I can add a tier 1 location down here that pays out in 0.4 of a year, we're going to be adding that to our inventory.
I just need one of those.
Unfortunately, I need more than one to make this work. So we're continuing to build a hopper.
I guess just 2 more slides. We're really proud of this slide. In the last 2 years, we've reduced our emissions intensity by 28% since 2021. It's a big thing for us, and we usually abandon about 2 to 3 wells for every well we drill. This is the final slide for us. As I mentioned earlier, we're almost every analyst's top pick or a top pick of their firm for oil in the country. Our net asset value total proves over $11. P plus P 17. We're trading just over PDP in the sevens. So very exciting for us. We think we are some of the best value in the industry. And you've seen the big guys run. This is very normal. You see the big guys run, and then you see the intermediates run, then you see the juniors run. Well, we're an intermediate. We're not CNRL size, but CNRL, Suncor, those stocks are ripping, and then you should start to see the surges and the white caps start going here soon. So that's our story. Excited about our positioning now, and as I say, we're getting close to hitting our next debt target. So any questions, Jess, for us?
Yeah, I have a few from the audience here. Obviously, we saw a big land sale from Crescent Point to soil. That's not stuff you would be drilling. But this person's asking if there's any interest in surge assets, but I'm assuming you don't really want to sell these assets.
Yeah, so to sell in Southeast Saskatchewan, no, we would be an acquirer, if anything, down in Southeast Saskatchewan for sure.
Yeah, exactly. But it's you are seeing more and more players get out, and you're becoming more the dominant player.
Yeah, I would say some of the bigger parties like the Crescent Points, Vermilion sold some packages out of here. Whitecap, they're still probably down here, but generally the bigger companies are moving out of here and focusing on sort of the deeper, more expensive Montney and that kind of thing. So it's a real niche for us to be a dominant player down here. So we still see some great opportunities from some smaller companies as well.
And you do it very well. So, okay. I'll take another one from the audience. What portion of your 2024 CaPex is focused on delineation of your land in order to get more of your unbooked locations into the company's reserve report?
Yeah, that varies year over year. I would say that this year we're probably about 10% of our drilling capital will be spent on more step out delineation wells. For the most part, fairly low risk in what we do. We have a good depth of inventory, but it is nice to prove up some of that. So it's pretty low. I'd say 10 to maybe 50% of our capital is spent doing that.
We could just take a step back to the M&A market. Is there a lot for sale right now in areas of interest for you, or not much?
Yeah, there's not that much. There's over 100,000 barrels a day are for sale in the areas we want to be in the Sparky and Southeast Saskatchewan. There's not near that much. Of the 100,000, Chevron's 40,000 in the Duvernay alone is for sale. Rumored that Paramount and Whitecap will be fighting over that. But in our areas, we don't see that much. So, as I say, we've been able to go almost close to 18 months now with no material acquisitions. The Enerplus deal turned out to be just a jewel, wildly accretive, long life reserves, and nice drilling up at Cadogan in our 2 core areas. So we're thrilled with that one, but we haven't seen much that fits us since then. So not a lot in our areas.
Well, and there's not much that competes with your economics of what you have for inventory. So
exactly.
Yeah. 2023 annual operating expenses were $196 million at $20 a barrel. Can you lay out the different components of this or commit to providing the four biggest components and the amounts in the next MBNA?
Yeah, I think we could probably do the second part of that. I know that power has been a huge cost and a huge inflationary thing over the last several years. But yeah, that's probably something we break out in the MDNA. Do you want to?
Yeah, I would say also with that $20 OPEX, when we think of our core areas, our OPEX is substantially lower than that. So we have OPEX in some of our non-core properties that is dragging that up. So we're focusing on what can we do to reduce that OPEX, even through rationalization or just some of the workover frequencies and that kind of thing. So in our core areas, our OPEX is substantially lower than that 20, but we're really trying to lower that in the non-cores to help bring down the corporate.
Yeah, I did want to ask what your views are on the power market for the next year.
Yeah, we've got a bunch of power hedged. Power's come in though nicely compared to what we thought it would be. So our hedges are right near on a mark to market, right near where the market is right now, about $70 per kilowatt hour kind of thing, give or take. It's now went way above that in winter, and it really worked well to have a bunch of our power hedged, but now it's come down a bit below that.
2024 excess free cash flow estimated at 57 million. Q1 free cash flow was negative after CaPex and dividends, as evidenced by a small increase in net debt. But it wasn't okay.
Okay,
Anyway.
there we're reading the question too. There, Gordon, that's a good question. So in this quarter, we should pay debt down 25 million, 30 million, because it's the breakup quarter. We're not drilling. So it's a very normal. So coming out of the chute in this year, in December, WTI was 68 at one point. So we pulled back capital out of Q1, kept our, and diffs blew up to 19 and change in average in Q1. Now WTI has gone up to 79 today, and diffs have gone from 19.50 to $12. So those are huge cash flow wins for Surge on a 74 cent dollar. There's probably a huge debt repayment in Q2 coming. And then in Q4 would be the rest of where we generate we came in within pennies of what we told the market in 2023 on a 77 WTI year. So yeah, we're right on track to have the 57 million of.
Okay, so we should hear some news on that over the next month or two, I would suspect.
Yeah.
I mean, you had it diffs blew out for you in Q4 and Q1. You spent a little bit more, and then there were 4 wells you couldn't complete, so you didn't have that production. So I think, it's easily explained away why your debt didn't come down as much as people had hoped in Q1 and Q4. But that, should really be fixed by diffs for the foreseeable future. Is that fair?
Yeah, I think that's fair, totally fair, and for us, if you're kind of thinking about it in terms of those acquisitions, if you combine our Q2, we should pay debt down 25-30 million. If we do a non-core sale, of Shaunavon, we will get to that next debt target quickly. So yeah, it's exciting because we've already hit the first one. We're getting close on the second one, and remember, our whole dividend is 48 million. When we hit the next debt target, hopefully in a few weeks, months here, that would mean another 57 million of free cash is we would allocate. We would just take a little bit and put it to the base, maybe 6, 8, 10% bump, but then look to start the share buyback program. We think that is a real winner in this program. We just wanted to hit the net debt target was first and paramount. Then it's we want to have the base dividend, a little tweak, but start the share buyback program for sure.
And one question here. On your CaPex, bottom up of wells plus water flood is a total of 190 million. There's a gap of 70 million, but isn't that mainly just gathering pipelines, things like water handling? Is that sort of?
Yeah, that's correct. So it would be some land seismic workovers, gathering systems, that kind of thing. Pretty normal to have that amount as our capital.
Yeah. The surge high torque to WTI, at what price would you consider hedging aggressively to lock in what would be huge free
Yeah,
cash.
so good. That's a good question again, Gordon. You're on fire here, buddy. We have done a bunch of research, and anytime you go above $80 WTI, you're in the 80th to 85th percentile of all-time pricing. So crude ran recently to 84, 5, 6, and we got some nice hedges off for the next 6, 8, 10 months at in the 81, 82 range. So next time crude rips, we're trying to be a little more systematic and make sure that when it hits those numbers, like you start getting into the 85th percentile, plus you're well above your budget. Our budget's 75, crude's over 79. And when it ripped to 85, take some. And if it goes higher, take some more and lock in numbers better than your budget. So we already got some, Gordon, we got some really good hedges off when crude ripped to 85 here recently, WTI, and locked in several thousand barrels, 2,000, 3,000 barrels, I believe, in the over 80 US WTI. Good question. And then around 50%, we stop because we figure if we're hedging well above our budget pricing, if it goes much higher, we'll take a little more and stuff, but we don't want to be speculating. If you hedge more than 50, 60%, you're starting to speculate. Then if it goes to 150, you can be offside with your paying your crown royalties.
Well, as I was going to say, I can think of one company many years ago that hedged all their production, and then gas went up considerably and they were screwed, and it really resulted in their bankruptcy. So they couldn't meet they couldn't meet how much they had hedged, and they were paying royalties at a much higher price. It's a very dangerous thing to do all your production.
Exactly.
Yeah. Okay, on your buyback, would you consider, at what price do you consider a buyback, like up to the $11 share price?
Yeah, that's actually one of the best questions because, as Derek showed, our net asset value, independently engineered at 75 flat oil pricing, is from Sproul, is about $11 total proved. P plus P is 17. We wouldn't probably run around hedging at 17, but if we're buyback, we would probably, at these levels, would be hoovering up the stock. As we get to $10, $11, we would taper that back and just use it strategically in the market for weeks when the market's acting silly and selling things off, be in there buying. And it's a great question because all we did is say, what are your priorities on capital allocation? Debt reduction. So we hit that target 1. We're close on that target 2, like literally within a few months. And as we hit it, small bump to the base, maybe 7, 8, 10% bump to the base, but really start an aggressive NCIB to buy the stock back and keep chunking down on the debt. Those would be the 2 priorities.
Okay. And one thing I'll ask for those who might be slightly bearish or concerned about downside protection, at what price is your dividend safe to at this point?
Good question. So we would have to see sustained oil below 68, 67, 65. If Derek and Murray Bai, who do our budgeting, if oil was at 68 for very long, you would see service costs drop and people would cut discretionary land, seismic, waterflood capital out of their budget. So I would say it'd have to be sustained below 65 for a period of time before we consider it. And if we can get these nice hedges on at 80, well, that means every time we do a hedge above 80, that means we're lowering our break even for the year on our capital and dividend. So I'd say 65, sustainably long-term price below that before our dividend is safe.
And given your low decline rate, you could cut some of that discretionary cash flow, et cetera. I mean, the discretionary CaPex.
Absolutely.
And still maintain your production.
Yeah.
Okay, here's a question. Have you had one of your investment banking firms perform a retro and forecast analysis on the value of on what value buybacks are? The math is easy on NAV, but to trading value, all relative to those using those funds as debt reduction. I can tell you, I asked our banking group back when I was in that side to do analysis on buybacks for small caps, and there wasn't enough data to actually give us any conclusion during that period, but that was a few years ago.
Yeah, so we do that all the time, and I see it's Scott asking that question. Good question as usual, Scott, who used to cover us back years ago, Jess, as you know. We always are looking at our equity cost of capital as measured in our trading price as measured against our net asset value, and then at what price tag. So the good part for us is we're 566 at $75 oil is our PDP NAV. Our total proves 11 at 75 oil. And then our equity cost of capital, is probably, I'm going to guess 40 to 50%. So buying our stock back till about $11 is a no-brainer for us because ours are low-risk conventional locations that have, if you combine the Sparky and Southeast Saskatchewan, probably over 200% rate of return wells. The Saskatchewan wells alone are over 400% rate of return. So we really believe, I guess I'm saying to you, in our total proved NAV of 11, and we're trading at, call it 7. So I think it's a no-brainer to buy our stock back in the market at these levels.
Okay, I think I've covered pretty much everything I had questions on. I'm definitely looking forward to more information coming from your multi-legs. I think the market is as well, and the debt repayment. Just a second. Good hear from Dan Steffens. Good job, a good quarter. EPG will be publishing an updated profile on Surge later this month, and we can discuss that after.
It was a really good, solid quarter, kind of boring, right in line with all analysts. In our particular situation, it's one of our solid, good quarters, but we have a number of good things, exciting things coming, including a potential non-core sale, hitting the next debt target early, and announcing, as Derek showed you, the Hope Valley results continue to look solid. So those are out there in the market, the Hope Valley results, but it's an exciting time for us with that discovery.
Okay, great. And so, we have a lot of catalysts to look forward to. And any big fears you see right now? I mean, I don't see any in the oil demand side of things at all. But there's always the naysayers.
I think OPEC's going to roll over their cuts here at the June meeting, and oil looks to be managed nicely, right in that $80 range. And again, for us, that is right around $108 Canadian a barrel. So Surge, we should be looking very good at $108 Canadian a barrel. And diffs have really come in on top of that. So probably one of the best times. And I think our stock and a lot of guys' stocks have been a bit soft here. I'm wondering what's going to happen with OPEC, the two wars going on. It just seems the price is being very managed very closely to that 80 WTI range. Well, we look great at 70, 75 at 80. We're throwing off immense free cash.
Yeah, I mean, you have a better leverage than Meg. So there you go. Right?
Yep.
So, okay, well, thanks for continuing to perform. And again, we look forward to the updates over the next month or so, and maybe even sooner. And well, just keep up the good work, guys. And
Thank you very much. Thanks for your time today.
And happy to continue to receive my dividend.
Thank you.
Okay, thank you.
Bye.